It's the most important, you say. Tell us why.
Well, the market has priced in a much more aggressive Fed than the market that Jay Powell would prefer to be the case. He doesn't want to talk about tapering yet. He understands that the market has moved in this direction, but by the same token, because the Fed is so meticulous, when it does embark upon shifts in policy, it knows that it doesn't need really longer than 2022 to carry out the taper, which would then segue into the first interest rate hike. The last thing Jay Powell wants to do is to be discussing policy changes in the current calendar year. So he's going to maintain his transitory, transient, patient take on inflation, despite what we're seeing going haywire throughout the commodities complex.
Should that change his mind?
Well, it remains to be seen. The truth is that American manufacturers, the factory floor in America has been disrupted in terms of the supply chain since the onset of the trade war. This is something that was seriously exacerbated by the pandemic, but we know that China is largely back up and running at prior capacity, and that a lot of the shipping disruptions are going to come unraveled, go the opposite direction in the coming months. When you start to see headlines like Chilean port workers are striking, and now the mining workers in Chile are starting to are threatening to strike as well. You see these huge pops that we've had in copper. Bad weather here in the States has pushed up the grains complex, and Americans are seeing. I was at the grocery store myself today. Americans are seeing much higher grocery bills than they had before. So the pressure is going to increase on Jay Powell as we head into these next two very nasty base effect months of seeing the April and the May prints off of such low levels in 2020.
Danielle, of course, the other factor that that Jay Powell and the team will be looking at are the jobs numbers, the unemployment numbers, as well as the inflation situation in the US. We've seen pretty solid job growth over the last few months. Is that trend expected to continue, do you think?
That part I'm not quite as certain about, because we have such an enormous proportion of the economy that is already open. A lot of the positions that have yet to be filled are the lowest skilled, and we've heard from employers coast to coast that this is more a reflection of the sheer level of unemployment benefits that are being provided. I'm not so sure that, given the lobbyist effort in Washington, D.C., that we don't see workers come back into the workforce after these unemployment benefits that are extraordinary expire on September the 6th. I know that I'm seeing the same things that Jay Powell's saying, and that he's going to take a wait and see approach, despite the fact that we are seeing wage inflation start to perk up. Again, there's still millions upon millions of Americans who manifest into this massive labor slack that exists. We don't see it as much, again, because they're being paid so much to not work.
Where are we in this economic cycle then in the US? Are we reaching a peak?
I've been studying markets and following economic data for a very long time. We're seeing some crazy haywire readings out of our soft survey data, whether it's the ISM or the regional Fed manufacturing surveys. What I have started to see, though, is a dissipation in delivery time pressures. Once you see that start to come off, and you're starting to see companies report that their inventories are being rebuilt, once we get past this massive supply-demand disconnect, imbalance, we will indeed see that we're going to be peaking out. And a lot of strategists, including myself, are saying that when we see these white-hot level readings in PMIs, in ISMs, that indeed we're at an inflection point where we do see peak growth turnover.
What would that, I mean, since you brought it up then, does that, people talk about, the debate right now is really, does the Fed hike next year, or can that be moved sooner? I mean, since you brought it up, is there a case to be made that we are, in fact, overestimating the recovery, and in fact, that future Fed rate hike might actually get pushed back?
That's a really good question because too few are asking it. And the fact is, we don't know what this economy functions. We don't know how this economy functions when it isn't being given constant injections of stimulus checks. We have yet to even take that stress test. We don't know what that scenario analysis pans out to look like. We have no idea. And the fact that there is such this grab for labor suggests that there is going to be increasing pressure headed into an election year. And what I would add will be a very contentious election year headed into the midterm elections. These will all be things that temper the Fed's impulse to tighten in 2022. And to your point, I don't think enough people are taking that into account. They're looking for earlier tightening than what's being anticipated. The Fed may be on the opposite end of the spectrum.